Preparation of financial statements. Hello students, welcome to the lecture on preparation of financial statements. After this lecture, you will be able to learn the following objectives. Describe the financial statements, discuss the classification of financial statements, explain the trading and profit and loss accounts, elaborate the preparation of balance sheet, understand the adjustments in preparation of financial statements. Introduction. Now let us know more about financial statements. Financial statement or financial analysis is the process of understanding the risk and profitability of a firm, business, sub-business or project through analysis of reported financial information, particularly annual and quarterly reports. Financial analysis is the selection, evaluation and interpretation of financial data along with other pertinent information to assist in investment and financial decision making. Analysis may be used internally to evaluate issues such as employee performance, the efficiency of operations and credit policies, and externally to evaluate potential investments and the credit worthiness of borrowers, among other things. The analyst draws the financial data needed in financial analysis from many sources. The primary source is the data provided by the company itself in its annual report and required disclosures. Financial statements are prepared to meet external reporting obligations and also for decision-making purposes. They play a dominant role in setting the frameworks of managerial decisions. Tools and techniques of financial statement analysis. Horizontal analysis. Horizontal analysis of financial statements can also be carried out by computing trend percentages. Trend percentage states several years' financial data in terms of a base year. The base year equals 100% with all other years stated in some percentage of this. Vertical analysis. Vertical analysis is the procedure of preparing and presenting common size statements. Common size statement is one that shows the items appearing on it in percentage form as well as in dollar form. Each item is stated as a percentage of sum total of which that item is a part. Key financial changes and trends can be highlighted by the use of common size statements.
The four major financial statements are the income statement, statement of changes in owner's equity, balance sheet and the statement of cash flows, which we can see in our Padisco textbook. The income statement summarises the revenues earned and expenses incurred over a period of time, which results in the net income or net loss of the business. Notice that net income is actually an input in the statement of changes in owner's equity. This statement identifies the movements in equity over a period of time, including investments and withdrawals by the owners of the business. Again, notice the ending balance of capital from the statement of changes in equity is reported in the equity section of the balance sheet. The balance sheet is like the accounting equation and presents the balance of the assets, liabilities and equity of the business at a specific point in time. It is like a snapshot of the business and is the only financial statement that is as at a particular point in time rather than over a period of time. The final financial statement is the statement of cash flows, which explains the inflows and outflows of cash from operating, investing and financing activities over a period of time. Note that the ending balance of cash in the cash flow statement is equal to the balance of cash reported.
Objectives of financial statements. The objective of the financial statement is to provide information that would convey to the users details of the performance, the financial position, and the changes in the financial position of the organization. This helps them in making economic decisions. These statements summarize assets, liabilities, equity, income, and expenses during a particular accounting period. The main objectives of the financial statements are as follows. Providing information about the financial position. refers to the reporting of assets and liabilities possessed by the organization. It depicts the financial position of the organization at the particular point of time. Providing information about the financial performance refers to the reporting of the expenses incurred and gains earned by the organization during an accounting period. It represents the organization's ability to use the available economic resources in a profitable manner. Providing information about changes in the financial position refers to the reporting of the effect of business activities on the stake of the investors in the organization. It is presented in the form of statement of cash flows and statement of changes in equity. Providing notes and supplementary schedules refers to information about the risks and uncertainties affecting the organization. In addition, it notices the item that is not mentioned in the balance sheet of the organization. Concept of capital and revenue expenditure. The preparation of financial statements is of great significance to the organization and is one of the most important activities in facilitating decision making to various users. Prior to the preparation of financial statements, an understanding of the concept of capital and revenue expenditure must be clear. This is because expenditure is an important element of every financial statement. The capital and revenue expenditure are described as follows. Capital expenditure refers to the expenditure occurred while acquiring assets that are held by the organization for a long term. Therefore, the income of a business increases with such kind of expenditure. The capital expenditure is made on fixed assets, which include purchase of furniture, plant, and patents. These assets are intended to be continually used in the business for earning revenue. Revenue expenditure refers to the expenditure incurred for running the business. It is the amount required for earning the revenue. All the establishments and other expenses incurred in the business, conduct and administration comes from the revenue expenditure. Classification of financial statements. Financial statements aim at recording the financial activities in terms of profit earned, loss incurred, and the financial position of the organization. These statements present the record of the financial activities in a prescribed manner to various parties. Users can get a better insight of the business and can acknowledge the strengths and weaknesses of the organization by analyzing these financial statements. The different types of accounts in financial statements. Trading account. The term trading refers to the selling and purchasing of goods. The trading account records the results of selling and purchasing of goods. It is mainly concerned with the determination of the gross profit or gross loss. According to Batley Boy, the trading account shows the result of buying and selling of goods. In preparing this account, the general establishment charges are ignored and only the transactions in goods are included. Explaining the items of trading account. The items that are enlisted in the trading account are explained as follows. Opening stock refers to the stock of goods in hand at the beginning of the accounting period. It is carried forward from the previous year and appears on the debit side of the trading account as it accounts for the cost of goods sold in the current year. Purchases refers to the goods that are purchased for resale to earn profits. These include both the cash and the credit sales and appear on the debit side of the trading account. Purchase returns refers to the goods that are returned back to the suppliers because the goods do not match the criteria or standards set by the organization. The purchase returns are subtracted from the purchases to get the net purchase. Wages refers to the compensation paid to the workers in return for their labor. It is paid on a daily or weekly basis. Wages are debited to the trading account. Carriage and freight inwards refers to the transportation expenses incurred for bringing the goods or material purchased to the premises of the organization. These expenses are debited to the trading account. Gas, fuel and power refers to the items that are used in the production process. These items form a part of the expenses and require to be debited to the trading account. Gross profit refers to the profit earned from the basic business operations, which include manufacturing, purchasing and selling of goods. Sales refers to the gross total sales of the goods made during the fiscal year. These include cash as well as credit sales and are shown on the credit side of the trading account. Return inwards refers to the goods returned by the customers. These are subtracted from the sales to obtain the net sales. Closing stock refers to the remaining stock at the end of the accounting period. It includes finished goods, raw materials and work in progress. The stock is to be credited in the trading account. Advantages of trading account. Some of the advantages of the trading account are as follows. Provides knowledge of the gross income or profit from buying and selling of goods. Detects the various changes in the trading activity and seeks to find out the strong and weak points of the trading activity. Facilitates comparison of the closing stock with the opening stock. Helps to determine the progress or deterioration in the business processes. Safeguards against future losses in the business by helping the user in effective decision making. Helps to detect any theft, leakage and wastage of stocks. Profit and loss account. The profit and loss account is prepared to ascertain the net profit earned or the net loss suffered by the business over an accounting period, depicting the financial performance of the organization. In this account, all indirect revenue expenses are shown on the debit side, whereas all the indirect revenue incomes are shown on the credit side. A profit and loss account can be prepared by considering the following points. Need to debit all the expenses. Required to credit all the incomes. Consider the balance amount, if any, as profit or loss. The main objectives of the profit and loss account are as follows. Determining net gain or loss of an organization. Controlling unnecessary expenses by providing information about the effect of individual expense on the net profit or loss of the organization. Helps in analyzing the progress of an organization by comparing the current and previous year's net profit. Helps in preparing the balance sheet, which would further indicate the financial position of an organization. Balance sheet. A balance sheet is the statement that summarizes and presents the financial position of an organization as on a particular date by showing the assets and liabilities of the business organization. It is prepared with an aim to know the exact financial position of the business on the last date of the financial year. The American Institute of Certified Public Accountants defines balance sheet as a tabular statement of summary of balances, debits and credits carried forward after an actual constructive closing of books of account and kept according to principles of accounting. In the balance sheet, assets are represented on the right side and liabilities are shown on the left side. Characteristics of a balance sheet. The characteristics of a balance sheet are as follows. Prepare on a particular date and thus shows the position of the organization at a point of time. Consider as a statement and not as account, as it enlists the assets and liabilities columns instead of showing the debit and credit columns. Prepare after the preparation of the trading account and the profit and loss account. Provide summarized information about the balances of various assets and liabilities along with their values and nature in a structured manner and on a particular date. Grouping and marshalling of assets and liabilities. According to the Institute of Chartered Accountants of India, ICAI, the arrangement of assets and liabilities in a particular order in the balance sheet is called grouping and marshalling of balance sheet. The term assets denotes all the economic resources of the business and includes all current and fixed assets. On the other hand, the term liabilities denotes all the claims made against the assets of the business. Adjustments in the preparation of financial statements. Accrual accounting depicts the following principles. The revenues and profitability are recognized on the earned basis and not on the receipt basis. The expenses are recognized on the incurred basis and not on the paid basis. As the accrual basis of accounting is followed by organizations, some adjustment in the entries are required at the end of the period to record change in the revenues, expenses, assets or liabilities that have not been recognized before. These adjustment entries modify the balance of certain accounts so that an appropriate and fair condition could be reflected by the financial accounts. Closing stock. The stock of goods that remain in an organization at the end of an accounting period is known as closing stock. The closing stock is valued at the end of the financial year. The adjustment of the entry can be made in the following two ways. Need to pass the entry at the debit side of the closing stock account and the credit side of trading account. Required to show the closing stock on the asset side of the balance sheet and is carried forward the next year. Outstanding expenses. Some expenses are accrued from the daily activities but are usually recorded only when they are actually paid. For example, salaries, commission and rent expenses. In some instances, certain expenses may remain unpaid on the date of preparation of financial statements. Such expenses are termed as outstanding expenses. Prepaid expenses. The paid expenses are the ones that are paid in advance, but the benefits of such expenses may not be fully received in the current accounting period. For example, payments of insurance premium, rent, and purchase of goods are made in advance. In such a case, the portion of the benefits not received is carried forward to the next accounting period. Accrued income refers to the income earned but not received till the end of the current accounting period. For example, interest on securities and dividend on shares are earned but may not be received in the same year. This type of income requires adjustments before the preparation of financial statements. The accrued income is shown at the credit side of the income account. Income received in advance. Any income received in advance should be calculated and brought into the account by carrying forward the advance receipt. For example, an advertising agency receives the payment of advertisement in advance. Similarly, insurance company can get the insurance premium in advance. Depreciation is an expense on account of a fall in the asset's value due to various reasons such as wear and tear and lapse of time. After utilizing the asset in the production process for a specific duration is fully justified, that the expense on the account should be calculated and brought into the final accounts. Bad debts and provision for doubtful debts. Sometimes there is a possibility that the full amount of the sales revenue may not be realized due to the occurrence of bad debts. The objective of making a bad debts provision is to bring down the balance of debtors to its true position so that the balance sheet may not exhibit. It is quite difficult to determine the accurate amount of the bad debts, and thus a reasonable estimate for such loss should be made. Provisions for discount on debtors. Discount allowed is an expense to the business. Discounts are provided to the debtors to encourage them for prompt payments. A discount allowed in the accounting period is estimated, and a provision is created for discounts on debtors. This is directly debited to the profit and loss account and credited in provision for discount on debtors account. The managers are given a commission based on a fixed percentage of the net profits earned by the business. In such cases, the total net profit is calculated and then the percentage of the commission is applied. The manager's outstanding commission would be shown on the debit side of the profit and loss account and as a liability on the liabilities side of the balance sheet. Now in the end, let us summarize what we have learnt in this lecture. Summary. Financial statement or financial analysis is the process of understanding the risk and profitability of a firm, business, sub-business or project through analysis of reported financial information, particularly annual and quarterly reports. The objective of the financial statement is to provide information that would convey to the users details of the performance, the financial position, and the changes in the financial position of the organization. The preparation of financial statements is of great significance to the organization and is one of the most important activities in facilitating decision making to various users. Financial statements aim at recording the financial activities in terms of profits earned, loss incurred, and the financial position of the organization. These statements present the record of the financial activities in a prescribed manner to various parties.